Welcome to MetalIQ, a channel built for investors who want clarity, not noise. If you're looking for emotional headlines, hype-driven predictions, or day-to-day price guessing, this isn't that channel. But if you want structured, data-driven analysis based on long-term market behavior, cycles, and historical precedent, you're in exactly the right place. Over the past several weeks, silver has begun doing something that only happens a handful of times in an investor's lifetime. On the surface, it looks like a strong rally. But when you step back and analyze the structure, the history, and the context, it becomes clear that this move is not just another short-term price fluctuation. It's part of a much larger process that has been building for decades. To understand what comes next, I didn't rely on one chart or one cycle. I analyzed more than 150 years of silver market history, including secular bull markets, cyclical corrections, inflationary periods, deflationary shocks, and major regime changes in global finance. And what that long-term data shows is remarkably consistent. Here's the key takeaway up front. Silver is likely to move higher from here, then experience a meaningful but controlled correction, and after that, enter a phase that historically leads to much higher prices over time. Not in a straight line, not without volatility, but within a framework that investors who understand cycles can prepare for and benefit from. This video is not about predicting tomorrow's price or chasing momentum. It's about understanding where we are in the larger silver cycle, what typically happens at this stage, and why the current breakout carries far more significance than most market participants realize. This analysis is being recorded on Monday, January 19th, 2026, and everything you're about to hear is grounded in long-term charts, ratios, and repeatable patterns, not opinions, not narratives, and not fear-based speculation. One of the biggest mistakes investors make with precious metals is focusing too narrowly on short-term moves. Silver, more than almost any other market, tends to compress for long periods of time and then release that energy in powerful multi-year moves. If you only look at the daily or weekly noise, you miss the signal entirely. In this video, we're going to zoom out and look at silver through multiple lenses. We'll start with the big picture structural breakout that has just occurred. We'll then move into what history tells us usually happens after breakouts of this magnitude. From there, we'll discuss realistic correction scenarios, key support zones, and why volatility does not equal failure in a secular bull market. We'll also examine silver in real terms, not just nominal price. That means looking at silver relative to the stock market, to gold, and to the dominant equity leaders of the last decade. These relationships often tell us far more than price alone, and right now, they are sending signals that deserve serious attention. Finally, we'll connect all of this to the broader capital rotation that appears to be underway, a shift that historically benefits precious metals and mining equities when it gains momentum. The goal here at MetalIQ is simple. Help you think clearly, manage risk intelligently, and understand where opportunity may be forming before it becomes obvious to everyone else. Whether you already hold silver, are considering an allocation, or simply want to understand what this market is signaling, this analysis will give you the framework to do that. So let's put the daily headlines aside, take a deep breath, and begin with the big picture, because that's where silver is quietly telling its most important story right now. To understand why the current move in silver matters so much, we need to step back and look at the structure of the market, not just the recent price action. Silver has just broken out of a base that took roughly 45 years to form. That alone puts this move into a very rare category. Markets do not spend 4.5 decades moving sideways by accident. Long bases like this represent prolonged periods of undervaluation, capital neglect, and structural suppression relative to other assets. When those bases finally resolve to the upside, the moves that follow are rarely small or short-lived. Silver's recent breakout is not just above a short-term resistance level. It is a breakout from a multi-generational consolidation, and history tells us that breakouts of this magnitude tend to carry far-reaching consequences. Right now, silver has a clearly defined measured upside target near $96 an ounce, based on the size of this base. As of today, silver is trading just below $90, which means that target has not yet been fulfilled. From a purely technical standpoint, that alone suggests there is still unfinished business on the upside in the near term. But the more important point isn't just the $96 level. It's what this breakout represents within the context of 150 years of silver market history. When we look back across that history, we find that silver has gone through long periods of compression followed by powerful expansion phases. The current setup closely resembles the early stages of those expansion phases, not the end. In other words, this is not the type of breakout that typically leads to an immediate collapse or a 40-50% drawdown. Those kinds of corrections usually come much later after prices have moved substantially higher and excess speculation is built up. That's a critical distinction, because one of the most common fears investors have right now is that silver is too extended, or that a massive bear market is imminent. The long-term data simply does not support that conclusion at this stage. Based on historical precedent, what usually happens after a breakout of this magnitude is a multi-phase advance. The first phase tends to be a strong initial push higher as price escapes the base. The second phase often includes a meaningful but controlled correction, typically in the range of 15 to 25%, which serves to reset momentum and shake out weak hands. And the third phase is where the most powerful gains tend to occur. That framework is exactly what the current structure in silver suggests. In the short term, silver still has room to move higher toward its measured target around $96 and potentially beyond that into the low 100s. That does not mean the move will be smooth or linear, but it does mean that the breakout itself has not yet run its course. So what's important to understand is that this breakout did not occur in isolation. It occurred after decades of underperformance relative to stocks, after years of declining interest from institutional capital, and after a prolonged period where silver was historically cheap in real terms. Those conditions are precisely what tend to precede major secular bull markets. Another key point here is that the scale of this breakout exceeds many of the notable silver moves of the past. When we compare it to previous breakouts, including those in the late 1970s and in 2010, the current structure stands out as more significant, not less. That does not guarantee a straight line move higher, but it does argue strongly against the idea that this rally is already over. In practical terms, this means investors should be thinking in terms of process, not prediction. Silver is transitioning from a long period of compression into a new regime. That transition involves volatility, pullbacks, and periods of consolidation. But it also tends to unfold over years, not weeks. The big mistake at moments like this is to focus exclusively on short-term risk while ignoring long-term opportunity. Yes, corrections will come. Yes, silver will not go up every day. But structurally, the market has already made a statement by breaking free from a 45-year base. And markets do not make statements like that lightly. Moving forward, we're going to narrow our focus and look at the near-term roadmap for silver. We'll talk about realistic upside targets, where corrections are likely to find support, and how to think about risk during this phase of the cycle, without losing sight of the much larger trend now unfolding. Now that we've established the importance of silver's long-term breakout, it's time to bring the focus in a bit and talk about the near-term roadmap. This is where a lot of investors get tripped up because strong secular trends still come with volatility, and understanding that volatility is essential to managing risk. As of this week, silver is trading just under $90 an ounce. From a structural standpoint, the most immediate and clearly defined target remains the measured upside objective near $96. That target is derived directly from the size of the base silver just broke out of, and historically markets tend to respect those levels. In practical terms, that means the current move higher is not yet complete. Silver still has room to run before we even begin talking about a meaningful correction. In fact, based on past breakouts of similar magnitude, it would not be unusual to see silver push beyond the $96 level and briefly trade into the $100 to $105 zone before any serious pullback begins. That brings us to the question everyone is asking right now. How big could the correction be and when might it happen? Based on historical behavior, the most likely scenario after silver fulfills its initial upside targets is a controlled correction in the range of roughly 17% to 25%. That may sound significant, but it's important to understand that corrections of that size are normal and healthy in strong bull markets. They help reset sentiment, relieve overbought conditions, and establish higher long-term support levels. What the data does not support at this stage is the idea of a sudden 40% or 50% collapse. Those types of declines tend to occur much later in a cycle, usually after prices have moved well above prior highs and speculative excess has become extreme. That is simply not where silver is right now. So where might support come in during a correction? There are two zones that stand out clearly on the charts. The first is in the low 80s, roughly around the $80 to $82 area. This zone represents prior resistance that should now act as support. If silver were to correct from the low 100s back into this area, that would still leave the larger bullish structure completely intact. Below that, there is a much stronger and more critical support zone near $70 an ounce. This level corresponds with multiple long-term reference points and would likely attract significant buying interest if tested. Importantly, even a move from $100 down to $70 would represent a normal retracement within a powerful secular trend, not a failure of the breakout. It's also worth emphasizing what a correction is not. A correction does not mean the bull market is over. It does not mean the breakout was false, and it does not mean investors missed their chance. In fact, historically, the best long-term opportunities in metals often emerge during or immediately after the first post-breakout correction. Another key piece of the near-term puzzle is the behavior of related markets, particularly mining equities. Over the last several sessions, we've seen silver and gold experience short-term selling pressure, while many mining stocks have shown signs of accumulation rather than distribution. That kind of divergence is often a subtle but important signal. When miners begin to hold up well, or even strengthen, during short-term pullbacks in the metals themselves, it suggests that longer-term capital is positioning for higher prices ahead. It also reinforces the idea that any near-term weakness in silver is more likely to be corrective, not the start of a larger decline. From a risk management perspective, this is a phase of the cycle where patience matters. Chasing price during extended runs tends to produce poor results, while panicking during normal pullbacks often leads to missed opportunity. The goal is not to catch every dollar of upside, but to align positioning with the dominant trend, which remains clearly higher. In short, the near-term roadmap for silver looks like this. Continued upside toward the mid to upper 90s, possibly extending into the low 100s, followed by a corrective phase that resets the market without breaking the larger structure. That process, while uncomfortable at times, is exactly how strong bull markets build a foundation for much bigger moves later on. Moving forward, we're going to step back again and look at silver in relative terms, against the stock market, against gold, and against the dominant equity leaders of the last decade. Those ratios often provide the earliest clues about major capital shifts, and right now they are beginning to tell a very interesting story. Understanding silver purely in isolation can be misleading. To get the full picture, we need to look at how silver is performing relative to other major financial benchmarks, primarily the stock market, gold, and key tech leaders represented by the Mag 7. These relationships often reveal opportunities or risks that raw price data alone cannot. Historically, silver has a pattern of undervaluation relative to stocks during extended compression phases. If you go back decades, Civil War, 1920s, 1980s, and even 2011, you'll see that silver often trades at significant discounts compared to the broader equity market before entering periods of explosive growth. Today, silver is still in the process of closing that historical gap, signaling that we are in the early stages of a secular bull market rather than the late stages of a speculative frenzy. One of the most telling indicators right now is the silver to S&P 500 ratio. Historically, when silver trades at low multiples relative to the S&P, it sets the stage for strong long-term performance. Looking at past peaks, even modest normalization in this ratio could translate to silver prices well above $250 per ounce. And over the longer horizon, into the 2030s, these comparisons suggest potential peaks approaching $1,000 per ounce when measured against the stock market. Silver's relationship to gold also provides critical context. While gold remains the larger and more liquid market, silver often amplifies trends established in gold. When gold breaks out relative to major equity indices or tech leaders, silver frequently follows, often with greater velocity. That dynamic is currently playing out as we see silver performing in alignment with early gold breakouts, while still retaining the capacity for significant upside due to its historical underperformance. The Mag 7, the largest technology companies that have dominated the stock market for the past decade, offers another layer of insight. As silver and gold begin to outperform relative to this group, it signals a rotation of capital away from conventional growth assets and into precious metals. This isn't just theoretical, it's observable in recent market behavior. Both gold and silver are starting to gain ground against the Mag 7, breaking through resistance levels that had previously capped relative performance. That's a strong early indicator that capital flows are shifting, and that precious metals are entering a new phase of institutional attention. Capital rotation is particularly important for investors to understand. While headline equity indices may appear strong, the movement of institutional capital often precedes broader market shifts. When we see ratios like silver to S&P or gold to Mag 7 breaking higher, it indicates that smart money is already positioning for the next leg in the metals cycle, even if retail sentiment remains skeptical. This phase can persist for months or even years, creating opportunities for those who recognize it early. Another historical reference point reinforces this argument. During prior secular bull markets in silver, we've seen multiple corrections along the way, yet the broader trend remained intact because institutional and long-term capital accumulation was ongoing. Today, ratios indicate a similar scenario. The broader market may experience intermittent volatility, but the underlying relative strength of silver and gold compared to major equities suggests that the secular bull remains firmly in place. It's also important to recognize the implications of this capital rotation for portfolio strategy. Investors who are aware of these relative movements can allocate positions more strategically, balancing near-term corrections with the potential for outsized long-term gains. Ratios like silver to S&P, gold to Mag 7, and silver to gold serve as early warning systems, highlighting not only potential upside, but also areas of relative weakness or overextension. In conclusion, the relative analysis confirms what we've already seen in the breakout itself. Silver is entering a phase of structural strength that goes beyond daily price fluctuations. The historical ratios, the performance relative to gold, and the emerging trends against the MAG7 all point toward a continuation of the bull market. This is the context in which near-term targets, corrections, and buying opportunities should be evaluated, because in precious metals, relative strength often precedes price recognition. Moving forward, we'll examine miners and smart money flows, highlighting where capital is moving behind the scenes, how mining equities behave during corrections, and why these signals often provide the earliest confirmation of the larger trend. Understanding this dynamic is critical for anyone looking to invest strategically in silver today. After analyzing silver itself and its relative performance against major benchmarks, the next critical piece of the puzzle is understanding miners and smart money behavior. Mining equities are not just proxies for silver. They often provide early, high-confidence signals about the underlying health of the market. Observing miners allows us to see where serious capital is positioning itself, often before the broader market recognizes the trend. Over the past several trading sessions, we've seen something very telling. While silver and gold have experienced modest pullbacks or sideways consolidation, many of the leading mining stocks have shown accumulation patterns as evidenced by positive candle formations and buying volume. This is an important divergence. When metals consolidate or slightly retrace but miners are accumulating, it signals strategic positioning by informed investors rather than retail panic. In other words, the smart money is already preparing for the next leg higher. Key ETFs like GDX, GDXJ, and SILJ illustrate this trend clearly. Recent daily and weekly candle charts show that after minor retests of support, these miners have not only held ground but in many cases strengthened. Successful retests of support levels are classic indicators of accumulation in a bull market, especially when these tests occur after a breakout in the underlying metal. Historical patterns confirm that these moments often precede substantial upside in both the miners themselves and the metals they represent. This behavior is consistent with what we saw in previous bull cycles. For example, during the breakout periods of 2010 and the late 1970s, mining equities often led the metal during corrections, providing early entry points for investors who are watching smart money flows. Today, the same dynamic is unfolding. Investors who observe these signals can gain confidence that the secular bull market is structurally supported, even if silver experiences short-term pullbacks. Another element to consider is the timing of corrections. Historically, the first significant post-breakout correction in silver tends to occur after initial measured upside targets are met, not during the early stages of the breakout. That means while silver may pause or pull back modestly, the underlying accumulation in miners suggests that long-term positioning remains bullish. The market is essentially digesting gains, creating a stronger foundation for the next upward move. Importantly, smart money behavior also highlights a distinction between weak and strong companies. Institutional investors tend to focus on quality juniors and established mining companies that offer both upside potential and operational stability. That is why tracking accumulation patterns in the top-tier mining equities is critical. These are the companies that often outperform the broader sector when the next surge in silver begins. Additionally, the data indicates that the broader capital allocation to precious metals remains far below historical peaks, especially relative to equities. For example, the proportion of ETF capital devoted to gold and silver miners is still significantly under its previous highs. This is crucial because it implies that even after substantial recent gains, there is still ample room for additional inflows, which can accelerate the next leg in both metals and mining equities. The takeaway here is clear. Monitoring miners provides both confirmation and context for silver's moves. While price action in silver is important, the behavior of smart money and mining stocks offers an early signal of strength and potential. For investors, this is actionable intelligence. Corrections in silver should not trigger panic. Instead, they often represent opportunities to align positions with smart money and prepare for the next phase of the cycle. In summary, silver's breakout is structurally strong, and miners are already signaling that capital is flowing in strategically. Accumulation patterns, successful support retests, and divergences between metals and mining stocks all point toward continued upside potential. Understanding these dynamics provides a crucial edge for investors who want to participate in the secular bull market in a disciplined, informed manner. Moving forward, we'll step back to the big picture endgame, tying together long-term cycles, peak targets, and what this all implies for silver heading into the 2030s. We'll cover the potential for $130, $250, and even $1,000 silver, and outline how investors can navigate this phase with clarity and confidence. As we reach the final part of this analysis, it's important to step back and look at the big picture. We've covered silver's historic breakout, short-term targets and corrections, relative performance, and miners' accumulation. Now let's focus on the ultimate trajectory and what it could mean over the next decade or more. Based on over 150 years of market history, combined with current structural signals, silver is on a multi-phase path. The first phase, already underway, involves the move from its current levels near $90 toward the measured upside target of $96-$100. Beyond that, the second phase includes a controlled correction, likely in the $80-$70 range, which will act as a foundation for the next leg up. These near-term dynamics are important, but they are only a prelude to the larger secular bull market. Looking further ahead, historical parallels suggest that silver could reach $130 in this cycle, reflecting the early to mid stages of the post-breakout expansion. From there, the secular bull narrative gains momentum as institutional and retail capital increasingly rotate into metals and miners. Beyond $130, we enter the zone where broader macro factors, such as inflation, monetary policy, and relative valuation to equities, start to accelerate the move toward $250 per ounce. But the truly extraordinary potential comes when we examine real-term ratios and historical peaks. Looking at silver relative to the S&P 500 during prior major peaks, 1920, 1980, and even 2011, normalized valuations suggest that silver could ultimately reach $1,000 per ounce in the 2030s. This is not speculative hype. It is grounded in historical precedent, relative valuations, and structural breakout patterns. When these metrics are aligned, they point to a magnitude of upside that most investors currently underestimate. It is also worth emphasizing that these moves will not occur in a straight line. Silver will experience cyclical fluctuations, corrections, and periods of consolidation, which are a natural part of secular bull markets. Understanding that volatility is part of the journey is essential for disciplined positioning. Those who panic during minor corrections often miss the most profitable phases of these multi-year cycles. At the same time, the big picture data suggests that any near-term pullbacks are buying opportunities, not signs of failure. The accumulation patterns in miners, the historical ratios against equities, and the relative underinvestment in metals all indicate that the market is still in the early to middle stages of a major structural move. For MetalIQ viewers, the key takeaway is this: think in cycles, not in daily prices. Aligning with the dominant trend, understanding where silver and its miners are likely headed over years, allows investors to manage risk intelligently while participating in potentially extraordinary gains. The secular bull market in silver is not hypothetical. It is already in motion, and positioning wisely now can produce outsized results over the coming decade. Before we close, let's recap the journey. Silver broke out of a 45-year base, signaling the start of a major multi-phase rally. Near-term targets point to $96 to $100, with a controlled correction likely afterward. Relative strength versus the stock market, gold, and the Mag 7 signals that smart money is positioning early. Miners are showing accumulation during pullbacks, confirming underlying structural support. Secular targets include $130, $250, and ultimately $1,000 per ounce, supported by historical ratios and long-term cycles. At MetalIQ, our mission is simple: give you clarity, insight, and actionable understanding of the metals markets. This isn't about chasing headlines. It's about recognizing structural trends, interpreting data correctly, and preparing for what comes next. From the next leg to $100 to the secular highs beyond $1,000. So as you consider your positions, remember to align with long-term cycles, monitor relative strength, and watch miners closely. Corrections are part of the process, but the broader trend remains clear and bullish. Thank you for watching this analysis. If you found this video valuable, don't forget to like, subscribe, and comment with your thoughts. We'll continue to break down metals markets with clarity, precision, and authority here at MetalIQ so you can make informed decisions and stay ahead of the curve.